Hey there, November 30th. We're at the end of November. Can't believe how fast it's passed. Scott Riley, the market update desk in Mortgage One. We had a lot of stuff going on today, so let's get right to it. Yesterday, we talked about two of the voting members of the Fed coming out and giving commentary. Today, we had a non-voting member come out and give their input. Atlanta Fed President Bostic, who said he believes that the downward trajectory of inflation will likely continue, and he thinks that the economic activity will slow in the coming months. Now, while Bostic is not a current voting member, he will be next year. So this does bode well for going into next year with the potential for rate cuts and another dove on the voting board. So that's good news. Today we had PCE, personal consumption expenditure, come out. We've been really waiting for this because we had that great CPI report a couple weeks ago. We wanted to try to keep this momentum rolling with bond market and mortgage-backed securities. So the personal consumption expenditure, which happens to be the Fed's favorite measure of inflation, they keep telling us, showed that for the headline PCE, inflation was flat for last month, which would be October, which is great news. Now, this was 1/10 lower than the estimates, and year-over-year index now dropped from 3.4 to 3%. We're within a tenth of having a two handle on headline PCE, which is, if you look at it from a year ago, that's a dramatic drop. So these are positive developments. Now, these were all in line with estimates. The core rate, which strips out the volatile food and energy, rose 0.2%, which was in line with estimates, and dropped us year over year from 3.7 to 3.5%. Now, one of the things Chairman Powell has talked about is annualizing the last 6 months run rate on PCE. So if we annualize the last 6 months of the core readings, which looks like it would be at about 2.4%, very close to their quote continued target of 2%. Great news. Now, the housing component of PCE, which takes up quite a bit of space of the entire PCE, rose at 0.43% last month and is up 6.9% year over year. Now, this is a downward trend from 7.2% the previous month. So we keep getting better on the housing component of PCE. If you were to play catch up with the shelter component within the PCE report and account for those lags, the real-time core inflation would be much closer to 2.6%. Once again, really close to this target rate that they've been preaching about. Personal income rose within the expected range at 0.2%. Spending rose 0.2%, which was in line, but it's still a dramatic decline from the previous month of a 0.7 increase. So that was all positive news within the PCE report. We were hoping maybe for a little less, maybe an extra tenth, but we're not going to complain about it. Jobless claims. Now, for initial filers for benefits, we saw an increase of 7,000 to 218,000, in line with estimates, but it could be skewed as the Thanksgiving week last week, and they don't have very good data, and it doesn't adjust for that time period. So we could definitely see a larger jump next week in initial claims. Continuing claims. This is another story, though. Now, this rose by a whopping 86,000 and is now at 1.927 million people on continuing claims. It's the first time we've been above 1.9 million in over 2 years. Now, this figure definitely points to a weakening of the job market, definitely in contradiction to Fed member Bauman yesterday, who kept talking about the strength of the employment. Pending home sales. Now, this is for signed contracts for existing homes in October, and that fell by 1.5% after raising 1% in September. Now, keep in mind, this is actually a little bit better than expected because they were looking for a 2% decline. Now, remember, when we were in October, we were hitting 8.25% interest rates. So this is still a good number, and we're going to look for this to be improved as we get the next report next month. Technical analysis. Right now, the mortgage-backed securities are sitting down 2 basis points. 10 years down 6, or up 6, I should say, to 4.32. Mortgage bonds have had an unbelievable run, but we're now hitting a tough customer in the 200-day moving average. It's a very tough ceiling of resistance. And not unsurprising, we're seeing some profits being taken. The 10-year is moving higher in a range of support from 4.056 and the 100-day moving average. These are both pretty tough levels. Now yesterday we dipped in the candle wick slightly below the resistance level of the 4.23. This could bode well because, as we've been saying, the next level of resistance is at 4.056. I think better days are still ahead. If we can pull through on the mortgage-backed securities through this resistance level, we've got another leg to run on. On the 10-year, if we can drop just a little bit, we've got, again, room to run to the downside to help mortgage rates. So that's the summary of today. And once again, we're talking about it. Take advantage of the rates now. Take advantage of less competition. Give us a call, 616-293-2189. We hope you have a fantastic day. Tomorrow's going to be definitely a slower day, but then next week ramps up big time with jobs report with ADP and BLS. Let's see what happens. Take care.